Hi, and welcome to Symax Fintech Weekly Report. This is part one. Here we're going to cover some of the macro, and then we'll come into the technicals on part two and part three. First of all, our disclaimer, please read it carefully. Trading involves the risk of loss of capital, and it's not suitable for everyone. Hopefully it is for you. And many companies provide leverage, so you should be aware that you can lose substantially more than your initial investment. The views, opinions formulated in here are mine, Chris Tubby, and all we're trying to do is provide you with some just insight into what's going on, but it is purely for educational purposes. So it's not investment advice, or we're not encouraging you to trade or invest. That has to be your decision. And of course, you should carefully consider your risks, your financial situation, definitely your level of experience, and obviously only risk capital that you're prepared and, more importantly, can afford to lose. You should seek financial independent advice if you have any doubts whatsoever before you risk your capital. So here's the highlights of last week. Data for the US economy is still strong. Not really a surprise. Their economy's been sort of boiling for quite some time now. Inflation's high, but also, over the lockdowns and everything, they have accumulated trillions of dollars across the households. Of course, some of that's against sort of share valuations, which have dropped down, obviously, so far all of this year. So that would have sort of impacted them slightly, but overall still in quite a strong position. UK sales were slightly better than expected, which gave the pound a little bit of a boost. And there are now expectations that China's growth will actually be behind the US. They may only manage 2% this year due to the lockdowns that they're having at the moment. Which will be the first year since 1976 that they've actually trailed the US for growth. Inflation's still high, obviously. It must be coming to peak soon. Stocks lower. This is the 7th week running that they've been down. Apple's traded down to $132, had a slight bounce at the end of the week. Zoom's down 80% from its high, and Tesla was down 14% just last week. So there's some of the big fallers. And of course with Twitter as well, because Musk's now put that deal on hold for the moment. Whether he's trying to negotiate a new price, having seen the stock markets drop, or whether he's having second thoughts, we'll have to wait and see. But again, with that, it's going to be interesting to see if he does finally buy Twitter, what he does in the way of using crypto, because he's quite a fan of it. So how he will use that, if he will use that. And then lastly, on Friday late afternoon, we did see a rally which saved the confirmation of a bearish market coming into play. Although on the S&P Friday there was a doji. So again, we're just going to have to wait and see what the markets bring this week. But the Fed, to a degree, are probably happy that the stocks are lower, because that is reducing the valuations of everybody's assets, which in turn could have a reduction on consumer spending. And obviously that's going to help them with the fact that they're constantly looking to put rates up practically for the rest of this year as they combat inflation. But of course, emphasis is a lot of that's still on the supply side. ECB minutes came out again. They were hawkish still, and we should expect to start to see some rate rises from them in the summer and onwards. Ukraine was downgraded to the 3rd lowest level for credit ratings, and again, it's to be expected. Hopefully, it seems as though Russia is struggling more and more, so it's possible that the banking system may get going again. Hopefully it will. Just a few contracts. So oil was strong between 103 and 113 last week. Gold steady. It did drop down to about 1785, closed the week 1845, looking a bit stronger. And again, with that inverse relationship, comes and goes with the stocks, but we could start to see that strengthen again, possibly. And the USD is off the highs, just a bit of profit taking, and of course, expectations of what's coming next are just becoming a slightly little bit more sort of unsure. Maybe investors are thinking maybe they're going to go a little bit too fast now with their rate hikes, or too aggressive, and they're going to overshoot, which personally I think they will. And Bitcoin was in a range of $3,000 range, so a good range, but and it's sort of getting sticky around about the $30,000 level. Key data this coming week in the EU, we've got the IFO business climate, we've got PMIs coming out across the globe, and personal consumption as well. In the US, PMI, new home sales, consumer confidence, sentiment, GDP, durable goods. The FOMC meeting's coming out Wednesday evening, so traders will have a very keen eye on what's coming from them, just to see how aggressive they potentially going to be. And then personal consumption in the UK, not too much. PMI and Bailey's speech are the highlights there. The macro outlook hasn't really changed that much. We've still got inflation, we've still got shrinkflation, we've still got the risk of stagflation and recessions around the corner, whether it be later this year or moving into 2023. Only time will tell. And again, of course, a lot of that is down to the supply chain issues. COVID, China's still having its lockdowns. And of course, just when we think we're out of COVID and everything's starting to get back to normal, now monkeypox is spreading. And again, it's going to have to wait and see how strong that gets, and the dangers of that one. Russia invasion of Ukraine isn't going quite as well, obviously, as Russia anticipated. Well, in fact, nowhere near. Having a slight bit of success, but not very much. And energy and food prices remain elevated. Rate increases are on the cards for almost everywhere except for China. They actually cut theirs slightly last week, put them down to 4.45% at the banks. But we've still got that lack of workers, although, if we start to see savings start to be depleted because of inflation, if we start to get valuations of everyone's assets looking weaker, obviously with the stock markets coming down, pensions, etc., all looking not quite so rosy as they did at the beginning of the year, then we may see a few more people suddenly become keener to go to work. Whether those jobs will still be there is another matter, though. Some EU states heading for stagflation or recession. Possibly, as I mentioned, I could still see the same thing happening next year in the US if Powell gets too aggressive with the rate rises. So this week's trading tip about risk management. So risk management, obviously essential in trading. It's the only way to enjoy longevity as a trader. If you're intraday trading or day trading, then focus on that risk reward. Make sure it's reasonable. Make sure it's at least 2 to 1. Now, it doesn't have to be fixed at 2 to 1. Sometimes you'll take a little bit less. Sometimes you can take more. But you've got to start somewhere. And for me, I've got nearly 50 years experience in trading. My minimum is 2 to 1. But I'm always a little bit flexible with that because you have to be. But you've got to be prepared to take losses when the market's going against you, especially in these markets, because otherwise they can be unforgiving. And just be flexible with your trading. And that's about it for the trading tip. But sort of just really think about your risk management. Obviously, investors do it a different way. They deal in percentages. But if you're trading regularly every day or every week, then just think more in financial terms, and we'll help you as much as possible. Again, there's just another reminder of our disclaimer. I went through it at the beginning, so I won't bore you with that again now. And some of our services that we do provide, our daily newsletter, which includes a lot of all this up-to-date global news, as well as chart levels and some views as well. We offer workshops, courses, master classes. We do trader mentoring. We consult. If you've got any questions whatsoever, feel free to reach out to us and contact us at info@symaxfintech.com. So that's the end of part one. Hope you've enjoyed that. We're just about to start part two now, and we look forward to seeing you on that one as well. Thanks for listening.